Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about, AMZN. We're focusing on Amazon, which as of late 2025 seems to be stuck trading in this really volatile, kind of tight range between, $230 and $238 a share.
Right.
And this fluctuation, I think, isn't just standard market noise. It feels like it reflects a deep internal tension within the company itself.
The central issue is this dramatic multi-billion-dollar shift Amazon is making toward total technical sovereignty. They're verticalizing their entire value chain, from proprietary silicone, we're talking Trainium3, all the way to global connectivity with Project Cooper.
And that pivot, that's the whole story right now. It requires immense capital expenditure, an annual spend now estimated to be well over $100 billion, and that spending is what's generating all the market friction. Exactly. So the core question before us is this. Is Amazon's aggressive CapEx strategy fundamentally a necessary investment, laying the foundation for long-term, unassailable value creation? I argue that it absolutely is.
And I maintain the precise opposite. While the long-term vision may be compelling, the market's current skepticism is entirely rational. This high CapEx burn represents an excessive short-term margin drain and, frankly, a significant speculative execution risk that the street is correctly factoring into its present valuation, constraining it to that narrow $230 range.
The market's reluctance, in my view, is a severe case of focusing on quarterly noise while completely ignoring the epoch-making construction that's happening. That $100 billion being channeled into AI infrastructure in Cooper isn't optional spending. It's the mandatory entry fee required to build the company's next great growth mechanism, what we are calling Flywheel 2.0.
Could you elaborate briefly on what you mean by Flywheel 2.0? I think most listeners are probably more familiar with the original retail-centric one.
Absolutely. Yeah. So the original Flywheel was simple, right? Lower prices led to more traffic, which brought in more sellers, and that created greater scale and efficiency. Flywheel 2.0 is the interlocking, self-reinforcing loop built around AWS. It starts with this massive AI investment, which is fueled by proprietary silicon, which in turn lowers costs and increases performance. And then, crucially, this whole system is supercharged by the vastly expanded customer reach and data acquisition provided by Quaper. It builds a moat that, it simply cannot be replicated. And the street is completely ignoring this potential moat, particularly the strategic value embedded in Project Quaper. Quaper is not just a competitor to Starlink, a company already valued in the $70 to $130 billion range. It is a weaponized customer acquisition tool. The market fails to appreciate the economics here.
Okay, that's an interesting frame, but economic value is tied to cash flow, and the immediate financial impact of this spending is impossible to ignore. The market's skepticism is entirely rational because it's focusing on the immediate margin compression caused by that $100 billion CapEx shock.
But that's so short-sighted.
Is it? Let's just look at Q3 2025 earnings. Amazon absolutely smashed expectations. They reported an EPS of $195 versus a consensus of $156, a huge beat. Yet the high CapEx disclosure and the guidance for continued spending caused the stock to dip nearly 3% immediately after hours. That shows the market isn't focused on past performance, but on the future required investment.
That brief dislocation was the result of high-frequency traders reacting to one metric, but the underlying LTV calculation proves the investment thesis. Just consider the lifetime value of a Cooper-connected customer. They are not just paying an ISP fee. They are instantly funneled deeper into the Prime retail ecosystem, adopting AWS services, and, generating exponential revenue streams compared to a pure-play satellite internet subscriber. Aggressive strategic models peg the long-term value of Cooper alone between $400 and $600 billion.
That's a huge number.
It is, and if that valuation holds, then buying AMZN stock at $230 today means you are acquiring a trillion-dollar company, essentially receiving its next massive growth engine for free. The numbers don't lie about value relative to peers either. The stock is cheap relative to its growth. Its PEG ratio, the price-to-earnings ratio divided by the earnings growth rate, is 1.4. This trades at a distinct discount compared to the big tech median of 1.9, which just screams undervaluation to me.
I'm just not convinced by that line of reasoning because it places too much faith in future exponential returns, and it ignores the cost of capital in the present. That immediate financial strain we saw after Q3 suggests many institutional investors view this massive spending not as building a moat, but as, well, the cost of staying alive in the cutthroat AI arms race. They are nervous that this investment might only preserve their market position rather than dramatically expand margins. And furthermore, we see this caution reflected clearly in institutional trading activity. Look at the off-exchange short volume ratio, which peaked at 37.79% on December 1st, 2025. This coincides with specific insider sales, signaling that sophisticated institutional capital is actively hedging and distributing shares quietly. It's a clear demonstration of managed skepticism about the CapEx trajectory.
Okay, that high short volume ratio is certainly a cautionary flag. I'll give you that. But before we really analyze that specific trading behavior, we need to address the most critical piece of the sovereignty argument, which is where the long-term leverage is actually created. That brings us to AWS and the fight against the NVIDIA tax.
Okay.
The verticalization of silicon, the move to proprietary chips, is the single most important margin play for AWS moving forward. That's where the CapEx stops being a drain and starts becoming a lever.
We both agree that success here is pivotal. I mean, AWS's dependency on NVIDIA GPUs represents a tremendous cost burden. It's effectively a tax on every successful AI deployment.
To eliminate that tax. The performance metrics are frankly blistering. We're talking 4 times the compute performance, 40% better energy efficiency, and a promised 50% lower total cost of ownership than comparable off-the-shelf NVIDIA GPU clusters. AWS has already deployed these chips internally, potentially numbering in the millions. This is not a pilot project. It is a full-scale assault on their highest input cost.
I'm sorry, but I just don't buy that the technical superiority, the better TCO, will translate immediately or easily into profit expansion. The fundamental barrier isn't the hardware, which, yes, Amazon has seemingly solved. It's the software moat.
You mean CUDA?
Exactly. NVIDIA's CUDA platform is deeply, perhaps permanently entrenched. The vast majority of the developer world, the talent, the tooling, the libraries, all of it is built around CUDA. AWS must convince thousands of engineers, companies, and data science teams to switch their pipelines and dedicated engineering resources over to its proprietary Neuron SDK. That transition involves significant friction and engineering costs for the customer. AWS is fighting a paradigm shift, not just a hardware battle. It costs time and money for a developer team to rewrite their code to take advantage of Trainium 3's efficiencies, and many simply won't if CUDA is easier and faster today.
That friction lessens with every TCO advantage, though. And more importantly, it lessens with every proprietary service AWS builds that relies exclusively on Trainium 3. This is where sovereignty pays off. They are creating services that are optimized and therefore priced at a level that external providers cannot match, compelling adoption over time. It is a long game.
But can Amazon afford a 3 to 5 year ramp-up period, sinking those immense costs while CUDA continues to widen its ecosystem lead? What if that friction isn't just slowed but stops the transition cold? If Trainium 3 only captures, say, 20% of the internal workload and stalls at 5% of external customer adoption, that CapEx investment becomes a massive deadweight.
That calculation assumes the market doesn't recognize the leverage point. We have to view Trainium 3 as a means of defending their market share against the hyperscalers who are trying to build their own silicon, and a means of increasing the margin on every AI service they currently sell. Even capturing half of their internal AI workload represents billions in saved costs annually. It's an unavoidable strategic move, even if the adoption curve is slow. The long-term necessity justifies the short-term cost.
The question is, how long is long-term? The market operates on a shorter horizon, especially when confronted with high-volume, high-risk trading signals. We can't just ignore the dark pool activity we discussed earlier.
Okay, let's go there.
When that off-exchange short-volume ratio approaches 38%, it suggests sophisticated institutional traders are using dark pools not just for liquidity, but actively betting against the stock's short-term capex story. They are not hiding buy orders. They are concealing distribution and hedging. They do this to avoid information leakage and to prevent depressing the bid price on public exchanges, which would signal massive selling pressure. The data proves that behind the scenes, the big money is actively managing the risk related to Amazon's massive spending.
I understand the technical argument about market mechanics, but the interpretation of that data, it needs context. This dark pool activity in the 30 to 35% range historically for Amazon is actually moderate compared to many mega-cap peers. Apple, for instance, frequently exceeds 40% short ratios off exchange, sometimes reaching as high as 55%. Dark pool migration is fundamentally a structural feature of modern markets, driven by the institutional need to minimize market impact and slippage on massive block orders. It's a mechanism for trading large volume, not necessarily a smoking gun of impending decline.
But you can't deny the signal it's sending in this specific context.
But institutional accumulation is often quiet as well. Long-term capital recognizes the formidable moat being dug. They are buying slowly, methodically, recognizing the value proposition even amidst short-term volatility. And the technical indicators confirm this. The stock remains above its critical 200-day moving average, sitting comfortably above $214, indicating the long-term uptrend, which is guided by fundamental value, remains very much intact. The market structure, while complex, does not negate the strong underlying performance.
I would frame it differently. The high short volume is not a prediction of collapse, but a highly sophisticated institutional acknowledgement of the execution risk, the risk that the Trainium 3 transition stalls, or that Cooper delays its revenue stream. It is a hedge against the uncertainty inherent in a $100 billion annual gamble.
That's a fair point about managing uncertainty, but it ignores where the general consensus on valuation is heading. I mean, analyst consensus is overwhelmingly bullish. 49 out of 56 brokerage firms rate the stock a strong buy, with an average price target of $297. They are already pricing in the success of the sovereignty strategy. They view the generative AI component not as a speculative expense, but as a critical upside call option sitting on top of an already championship-level core business. Amazon's core retail and cloud infrastructure performance, the steady, high-leverage value generation, is so powerful and consistent, we've called it Jokic-level core performance. It's the quiet, dominant engine that generates the cash flow required to fund the revolutionary capex.
That's a compelling argument based on fundamental strength and forward projections. But have you considered the serious macroeconomic headwinds that place a persistent ceiling on this stock, regardless of its internal excellence? The Raymond James downgrade in December 2025 specifically cited tariff worries. As the world's largest retailer, Amazon is extraordinarily sensitive to cross-border trade costs and supply chain integrity. New or threatened tariffs on Asian goods, particularly electronic components and consumer products, instantly impact their retail margins and increase fulfillment costs globally. This external, non-fundamental factor creates a gravitational pull that limits how high valuation multiples can fly, especially when paired with the uncertainty of a $100 billion capex bill. It forces leadership rotation out of these massive, globally exposed megacaps and into less geographically sensitive sectors.
That's an external risk faced by every global retailer, though, not a unique indictment of Amazon's strategy. And, furthermore, the push for sovereignty, building their own silicon and owning their connectivity, is specifically designed to mitigate reliance on globally fragile supply chains, increasing resiliency over the long term.
While the tariffs are global, Amazon's capex makes them uniquely sensitive. They are already spending $100 billion to build future margin. Any tariff shock that compresses current retail margins limits their ability to sustain that capex without taking on massive debt or impacting free cash flow projections. The external risk multiplies the internal financial uncertainty.
That uncertainty puts a ceiling on the stock that the analyst's $297 price targets don't fully acknowledge in a rising geopolitical risk environment.
Look, the debate truly highlights that the volatility we are seeing in AMZN, trading in that narrow range, is really just the price of admission for a company aggressively constructing a vertically integrated sovereign ecosystem. The long-term upside resides squarely in the margin capture from internal silicon and the exponential customer acquisition potential embedded in Kuiper. These moves confirm that the company is fundamentally coiled for its next inevitable phase of growth, regardless of short-term market noise.
And the tension remains. Until AWS demonstrates tangible, measurable returns on that $100 billion CapEx and successfully overcomes the significant software friction required for mass adoption of Trainium3, institutional skepticism, reflected in high dark pool hedging and conservative trading volume behavior, will continue to dampen any sustained rally. The stock price will remain constrained by the dual pressures of execution risk and current financial strain. So ultimately, the decision for investors really hinges on their time horizon. Do they have the patience to hold while Amazon endures the necessary short-term capital expenditure burden for the promised return of total sovereignty in the cloud and retail spheres? Or do they prioritize immediate returns and caution against the significant, measurable execution risk that still looms? This massive strategic trade-off will define Amazon's valuation for the coming decade.